Hi everyone, welcome back to my channel. Today we're diving into the latest monetary policy announcement from the Federal Reserve's Federal Open Market Committee, comparing the Wednesday statement with the one from September. The Fed just changed a few words in its latest FOMC statement, but those few words could shift interest rates, markets, and even your savings. Today we'll break down exactly what the Fed removed, what it added, and what it really means for your money. Hi everyone. Welcome back to my channel. Today we're diving into the latest monetary policy announcement from the Federal Reserve's Federal Open Market Committee, comparing the Wednesday statement with the one from September. We'll highlight what language was removed, what was added, and what it means for interest rates, inflation, and the markets. If you want to stay up to date with central bank decisions, make sure you subscribe and hit the bell. 1. Context. Before we compare the text, let's set up the context. In the September meeting on or around September 17, 2025, the FOMC cut its target range for the federal funds rate by 1/4 percentage point to 4.00%, 4.25%. This marked the first rate cut in 2025 and came as the committee noted that downside risks to employment had risen. Fast forward to Wednesday's meeting October 28 to 29, 2025, the Fed again cut the rate by 1/4 point to 3.75%, 4.00%, and made some shifts in its language and stance. So we're comparing two consecutive rate cut statements and, importantly, comparing the language changes in the official FOMC statement. Language matters. It gives us clues about the Fed's thinking about risks, inflation, employment, and what they're signaling to markets. September Wednesday. Here are some of the key phrases from the September statement that were deleted in the Wednesday version. I'll show them with strike-through in red. 1. That phrase emphasized elevated uncertainty in September. 2. The reference to downside risks to employment was explicitly present. 3. This was a reference to ongoing balance sheet runoff quantitative tightening. 4. A forward-looking statement of conditionality. What the deletion of that language suggests. Perhaps the Fed felt it no longer needed to emphasize the same level of uncertainty about employment downside, or that the balance sheet runoff reference was no longer deemed necessary in the new statement. Section 3. Key added language Wednesday. Now let's look at the new phrases in the Wednesday statement. These are shown in red and underlined. 1. In support of its goals and in light of the shift in the balance of risks, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 3.75% to 4%. This emphasizes shift in the balance of risks. 2. The committee will assess carefully incoming data, the evolving outlook, and the balance of risks in considering additional adjustments. Puts even stronger language on incoming data and evolving outlook. 3. The committee expects that some additional policy firming may be appropriate if incoming information indicates that inflation pressures are not abating. Hypothetical example. The actual wording may vary if present. This would signal a conditional on inflation. 4. The committee will continue to monitor the implications of incoming information for the economic outlook and the risks to its goals. Reinforces monitoring of risk. What the additions suggest, the Fed is putting greater emphasis on the balance of risks, incoming data, and evolving outlook, possibly signaling more caution, more conditionality, and less automatic easing going forward. For what do these changes mean? Let's interpret what these textual changes may imply. By removing explicit language about downside risks to employment and uncertainty remaining elevated, the Fed may feel somewhat more confident, or at least less worried, about the employment side, or is shifting the narrative. The stronger emphasis on balance of risks and incoming data/evolving outlook underscores a data-dependent approach from here. The Fed is signaling that future moves will hinge on what the data show rather than committing to a preset path. The deletion of the explicit reference to continuing balance sheet runoff suggests they may be moving away from focusing publicly on that or deem it less relevant for markets at the moment. Markets listening to this language may interpret a signal that, while rate cuts are ongoing, they are not guaranteed. The Fed is maintaining optionality and sign all. Like, share, comment, thank you.